Welcome everyone. On today's video, we will be discussing the iShares S&P TSX Composite High Dividend Index ETF. If that sounded like a mouthful, don't let that scare you off. It's really simple, guys. This is a high yielding Canadian dividend paying ETF with all the individual equities that a dividend investor would want to hold. It trades under ticker symbol XEI and has a 12-month trailing yield of 5.11%. So, I mean, anything north of 5%, I'm going to consider high yield, and this is why a lot of income seekers like this product. It has a very low fee as well, which is very important, and the current fee is 0.22% for the MER, which is really competitive and low. Alternatively, another Canadian high dividend ETF would be VDY, but that one has a slightly lower yield, a similar management and expense ratio. But in my opinion, you probably have slightly higher capital gains than that one. I mean, it's really, you're picking hairs here. I like XEI if you want to maximize your income. Now let's just take a look at the holdings in this ETF because you should know what you own. As of today, the biggest holding is Enbridge, followed by TC Energy. So anyone who is into dividend investing in this country, Canada, really knows about these two companies because they both yield north of 7%, which makes them extremely popular in the community. Now, the overall weight in the ETF is about 5% each. Following that, we have TD Bank and Royal Bank at around 5% each. Now, there's a big drop off here because these two banks yield individually around 4.5% each. But they are the two absolute best banks in the country, in my opinion. Some people would argue for National Bank of Canada, though, in front of TD. But these are the two banks that I would like to own. After that, just under a 5% weighting, we have TELUS, which on its own yields north of 6% and is a great dividend company to own right now. It's been getting beat up this year. I just bought some more recently. I've done a video on it. I really like holding this one, and it's good to see some communication stocks up here on the list. After that, we have Suncor. I think this one is not as good as Canadian Natural Resources. It's not even close, but they have it as a higher weighting. The fund managers have their own reasoning. Either way, it's close at 4.9%, and then we have CNR at 4.7%. We also have Bell here on the list, which is very undervalued at the moment because of the interest rates. Bell has north of a 7% yield right now and is a bit of a steady Eddie in my opinion. So it's a good one to have in a portfolio. You don't want to overweight it, but just about 5%. I think that is a reasonable amount of Bell to own. We also have the Bank of Montreal and Fortis. Fortis is a Canadian superstar. It's almost a dividend king. I believe this year it'll reach the dividend king status, and it is the best managed utility in the country in my opinion, and the overall weighting of this ETF is 4.5% on this one. Now, I will mention that this ETF is extremely front loaded because we're about to go down in overall weight pretty significantly now, starting with Bank of Nova Scotia. This on its own yields north of 6%, followed by Brookfield Infrastructure Partners. I think this is a really good buy right now. I have a lot of this company myself. Then we have Pembina, CIBC, Manulife. I like having Manulife here and Sun Life because yes, it is a financial, but we're getting away from the Canadian banking system. We're getting some insurance, so it's a little bit of a diversification play in this ETF, and it's nice to have. We also have Emera, National Bank of Canada, and Canadian Tire. Now, Canadian Tire is a really good dividend payer. They've been raising the dividends aggressively, which I like. They buy back a lot of shares, and it diversifies this ETF a little bit because this is the first sign of consumer discretionary that we've seen here. After that, we have Brookfield Renewable, which I also think is a good buy right now. But after that, we're getting to really tiny percentage of the overall ETF here, like 1% and lower. I don't really bother looking at that much. There's still some companies I like Granite Real Estate Investment Trust. This is one that I own individually that I really like, but we're getting into some tiny players from here on in. So we just briefly went over the fund's top holdings, but it's good to have a little visualization of how the fund is diversified. So up here, we can see that financials represent 30% of the ETF, energy at 29%, utilities at 17%, communication stocks at 10%, real estate at 6%, materials now we're getting really, really tiny, guys. 1.6 consumer discretionary. I believe that's all Canadian Tire at 1.3, industrials just over 1%, and they have a little bit of cash and healthcare on hand. Now, this is a pretty good mix, but you need to ask yourself, say this was the only ETF in your investment portfolio and you wanted to live off the income from this ETF, would you be comfortable owning 30% financials? Would you be comfortable owning 29% energy? Would you be comfortable owning 17% utilities? I wouldn't necessarily. I think those percentages are way, way too high. This ETF is something that I would have a little piece of my investment portfolio in, not the whole thing, because this is really skewed towards high dividend payers. And when you have high dividend payers, you don't have the same amount of dividend growth going forward. It's already kind of built in. So that's my opinion. This might suit a lot of investors out there. This isn't the only ETF that I would buy, but it could really help some of us out there who are looking for the high income. And on another note, all these companies that we looked at here in the holding list, these are all Canadian. So if you hold them in a taxable account, you will get the Canadian dividend tax credit for them. I think this ETF suits a lot of needs specifically for income investors. But if we just take a look here, guys, from 2011 up until present day, this fund hasn't really given much gains. Okay, so this is mainly an income play. It was $23 in April 2011, and it's only $24.70 in September 2023. So this isn't where you're going to make a ton of money, but this is where you're going to have some income coming into your account. So it suits the needs of some, but not everyone. I hope you enjoyed the video, guys, and we'll see you next time. Thanks.